Hey everyone, welcome back to my channel. I'm Aaron Knightley, and in today's video I'm going to be talking about what investment is my preferred for larger capital. So a question I'm asked all the time is, Aaron, I've got a certain amount of money and I'm not overly sure what to do with it, because obviously there are a lot of options. We can use apps, we can go into the stock market, we can go into crypto, we can go into meme stocks, we can go into property if you have enough money. So there are a lot of options out there, but what do I prefer to do? Well, firstly, there's no financial advice. These are my own preferences, and I use a certain investment called fixed investing because it works year after year after year. It's a very good compounding investment. So I'm going to give you some of the pros to what a fixed investment does, and I aim through property development when I invest into a fixed term. So I'm lending my money out for an agreed term, agreed length of term, for a set interest rate that I get back at the end. Capital and interest all rolled up. So what are the bonuses when it comes to fixed investments? They're hands off. So that's what I like. I don't have to be involved. I don't have to take control. What I do like about it though is I understand the model. So that's the most important thing, is when you're investing, you need to understand it. And I've covered that off in my other videos. And actually what I'll do is I'll put a link just above me about where I lost £12,000 on a very good example of where I didn't actually understand what I was investing in, and as a result I lost it. When it comes to fixed investing through property development, I do understand it. The other bonus is it's a balanced risk. Obviously, every investment holds its own level of risk, low, medium or high. If you go into something with minimal security, it's at the higher end. If you go into something with some form of security, you're sort of medium, aiming towards the low. On a property, for example, you've got first charge, so you're on a low risk. When you invest into fixed investments, my particular clients that I lend money to, they have a multi-asset portfolio, so my money gets spread across all of their developments and the assets that they hold within that company. So it's balanced. The other thing that I like about it is reasonable terms that you can achieve. So you could see 12 month, 24, perhaps a little bit longer, up to 36 months. So depending on your personal circumstances of when you need that money for, you want to get it out of the bank, those options are available. That's what I like, so I've got a bit of option. I typically choose a 24-month term, so 2 years. That works very well for me. Competitive interest rates. So obviously, you know, we're going to try and beat the market when we're investing, but we're going to aim for the higher end. So anywhere between 7 and 12% is something I'm comfortable with and happy with. I'm beating the bank and I'm beating the market. Stock market, you might see anywhere on average per annum between that 6 to perhaps 12%. So I'm staying within that bracket, if not beating it. Again, I focus on property development, so there are different avenues you can go down when it comes to fixed investing, you know, depending on what projects, but I aim mine into the property development sector. Multi-asset exit strategy. Now, what does that mean? So when I invest, instead of going into a single project, which I still do, I diversify into one project and I lend my money that way. But when it comes to larger capital, I want to be spreading my money across different assets that will have different exit strategies. So for example, I lend my money to my client, they have a commercial, they have a residential, they might have a government scheme going on, something like that. So there are different avenues to exit from. So if one project is slower and you can't get out of that, they could refinance against these other projects or sell off other bits that they have within their pipeline. So there's different exit strategies. I look for companies that are partnered with strong companies, normally high street brands. If someone is partnered and has been for years, then that offers some reassurance, because you think, well, that high street brand wouldn't be partnering with this company if there wasn't a good reputation there. So that's something I look for as well, high street brand partnerships. Always look for a strong board of directors. I like to look for a company when investing into these fixed terms, the board of directors are fresh, young, and they keep coming through the door, you know. So if a board of directors have been sitting there for 10, 30, 40 years and they've not moved on, perhaps I might look into it a bit more, because I like to see board of directors moving or changing, or, you know, bringing on fresh blood so that things evolve. That's what I look for. Compound effect. So fixed investing is fantastic for the compound effect. So you think you're getting a great interest rate over a 2-year period, and then you can roll your capital over. Slow and steady wins the race. That is the whole compounding effect. So fixed investment offers that and you know what you're getting. So you invest into a product and you know exactly what's going in and what's coming out, and you can recycle and recycle year after year. Opportunity to roll over and continuously grow your capital. That's what I like about fixed investing through some of my clients, is that the opportunity is always there. So I can drip feed money. Typically I normally do it 3 times a year. So I can recycle every single year, and that comes back 3 times. So the compound effect speeds up. I think what most people struggle with when I've spoken with people when they think long-term investing is they go, oh, but it's going to take me a year, 2 years, perhaps 3 years to get my money and capital back. Yeah, that's the fact. It takes time. So that is what compounding investing is. It happens over a long period of time, but the compound effect really takes place. And believe me, when you get into your 3rd and 4th year and you've rolled over capital and recycled, then you start seeing the effects and the real bonuses to how much your capital can grow. So that's what I like to invest in. I hope that helped. Please do like and subscribe, share this, and for perhaps any questions around my investments, again, there's no financial advice, but if you want to know a little bit more, reach out to me on YouTube or go through my website, aaronknightley.co.uk. And until the next video, I will speak to all of you very soon.